Welcome to the deep dive. We are jumping straight into, well, what feels like the ultimate puzzle box of global finance today.
Uh-huh.
How can a world-class compounding machine, a company backed by legendary investors with a track record of, 18 to 19% annual returns for 30 years, still be trading at what looks like a 50% discount?
It really is the central paradox, isn't it?
Yeah.
We're talking about Brookfield Corporation, ticker BNN, a global powerhouse, holding assets that are basically the backbone of the global economy.
Yeah, think power grids, pipelines, massive data centers, iconic real estate.
Exactly. They manage over $1 trillion in assets, headquartered up in Toronto, though their big asset management arm is now really centered in New York.
Okay.
But despite all that, the market seems, profoundly confused about its true worth.
And you shared some great sources detailing this huge enterprise. So our mission today is pretty surgical, right? We need to unpack this staggering complexity.
That's the goal.
We need to understand the pieces. The asset management arm, this explosive growth in their wealth solutions business, and that huge portfolio of direct operating businesses they own.
And ultimately, we're trying to figure out where the value is that the market seems to be missing. If management genuinely believes the intrinsic value is around $100 per share.
And the stock's just bumping around in the, $47 to $58 range?
Yeah, that gap is either a massive opportunity or it points to some, massive structural confusion the market just can't get past.
And we know it's not just theoretical. Look at investor confidence. Bill Ackman, Pershing Square, he's been buying aggressively.
3 consecutive quarters now.
Building a position worth over $2 billion. That's serious capital. Betting this discount is temporary. So let's really dig into the details here. Okay, let's start right there with the core conflict, the numbers. You've got CEO Bruce Flatt and his team saying consistently, look, the intrinsic value here is about $100 per share.
Right, they lay it out pretty clearly.
But the market price just stubbornly stays in that mid-$50 range. That's not just a gap, it's a chasm.
It really is. It's like a profound market judgment saying, sorry, we don't quite believe you. And we can obviously quantify this judgment if we look at standard valuation multiples, specifically against what they call distributable earnings, or DE.
Okay, so let's compare them. How does Brookfield stack up against its U.S. peers, the big names in alternative asset management?
Well, you take Blackstone, probably the closest comp in scale and scope. Blackstone trades at a hefty 24.3 times expected distributable earnings.
Okay.
KKR. Also strong, 20.1 times DE. Now, Brookfield is trading at only about 13.2 times expected DE.
Wow, that's a huge difference.
It is. It's valued much closer to Apollo, which is around 14.6 times DE.
Yeah.
But, Apollo's business mix is a bit different historically, more credit-focused, maybe seen as having more cyclical assets than Brookfield's typical long-life infrastructure like toll roads and power plants.
So if Brookfield just traded at the median multiple of its peers, the stock price would essentially double almost overnight.
Pretty much, yeah. But management doesn't just rely on DE multiples. They give the market this other valuation tool they call plan value. What exactly is that?
Right, the plan value. What is that?
So the plan value is their own internal methodology. It's basically a detailed sum of the parts calculation. They break down the estimated value of, everything. Their stakes in the listed affiliates like Brookfield Infrastructure Partners or Brookfield Renewable Partners.
Okay.
Their private equity holdings, the projected value of that growing wealth solutions business, it's all itemized.
And what's that internal roadmap pointing to right now? What's the number?
The latest calculation puts the intrinsic value at $91.76 per share. And management emphasizes this isn't some wild guess. It's based on their view of conservative cash flow assumptions and what comparable assets are trading for.
So they're basically saying, look, the stock is selling for 50 cents on the dollar. The sources you shared suggested this level of transparency is actually pretty unusual for a firm this big.
It is quite detailed, which makes the market's refusal to accept it even more, baffling.
So if the map is right there, why won't the market use it? Which brings us straight to the likely culprit, the complexity discount.
Precisely. That's the phrase you hear again and again. The core issue is the complicated financials, the convoluted reporting structure. One analyst source described Brookfield as being like a Rolex watch. Meaning intricate, lots of moving parts, beautifully engineered maybe, but just too complex for the average investor or even many analysts to quickly take apart and understand.
And where does that complexity come from?
It stems from a few things: the sheer number of listed affiliates they have stakes in, the constant flow of transactions within the group, like selling assets from the parent company into funds managed by the asset manager.
Okay, those intra-group deals.
Yeah. And crucially, the way they consolidate massive amounts of non-recourse debt onto the parent company's balance sheet, it makes the official numbers look really intimidating.
Let's dig into that complexity a bit. When an analyst opens the official statements, the IFRS or GAAP reports, what do they see that makes them just throw up their hands?
Well, they see volatility. Volatility that suggests instability, even when the underlying businesses, the actual assets, are rock-solid cash-generating machines.
Like what?
Okay, take the official GAAP net income. It can swing wildly. Recently, it was reported around, say, $641 million for a period. But that number includes all sorts of non-cash items, like depreciation on assets that are actually appreciating in value over time.
Right, like a hydroelectric dam doesn't really depreciate in the economic sense.
Exactly. And it includes accounting noise from marking assets to market, which can cause huge paper profits or losses depending on market sentiment, not actual cash flow.
And this is where management's preferred metric comes in distributable earnings before realizations, or DEBR. Why should we, or the market, trust this internal number over the official GAAP figure?
Because DEBR is designed to give a clearer picture of the actual operational cash flow available to the parent company, BN. It strips out that often non-economic depreciation on real assets,
Okay.
and it excludes the lumpy, often large gains from selling assets. It focuses on the sticky, predictable cash earnings power from operations. So Brookfield reported annual DEBR of about $5.2 billion, or 3.26 per share.
So you have this massive gap. Volatile GAAP net income at $641 million versus stable cash earnings power via DEBR at $5.2 billion.
Right. And that difference is so dramatic that analysts who don't have deep expertise in Brookfield, or maybe don't have the time to reconcile it all, they often abandon coverage. If you can't easily slot a company into your standard valuation model, the default reaction is often to just slap a big complexity discount on it and move on.
Okay, so to really understand this complexity, we probably need to understand the company's DNA. This firm didn't just appear as a modern asset manager, right? It started by actually building things.
Absolutely. The roots go way back.
Yeah.
1899 in Brazil, believe it or not.
So.
Yeah. The company started as the São Paulo Tramway Light and Power Company Limited, founded by Canadian William Mackenzie and an American, Frederick Stark Pearson. Their vision was, frankly, brilliant for the time.
What was it?
They aimed to build the entire essential infrastructure: electricity, transit systems, street lighting needed to power São Paulo, which was booming as the world's coffee capital.
So they weren't just building a power plant, they were building the whole ecosystem, playing the long game from day one.
Exactly. The original insight wasn't about quit flips or financial engineering. It was about generational control. If you control the essential infrastructure, you basically control the future development of the city.
And that DNA, that history as an operator, someone who actually digs the tunnels, runs the power plants, that still defines them today.
It's arguably what distinguishes them most.
Yeah.
But that history also includes a period of, let's say, intense financial engineering in the 70s and 80s under the Braskin name. This was when Jack Cockwell was managing things for the Bronfman family.
Ah, the Braskin era. That seems key to understanding the structural complexity we see today. How did Cockwell's approach sort of set the stage?
Cockwell was a master of using complex, almost pyramid-like ownership structures. The idea was always to maximize control with minimal cash invested at the top.
How did that work?
You'd have a parent company controlling a subsidiary with maybe just over 50% ownership, but consolidating 100% of its assets. That subsidiary in turn controlled another one, and so on down the chain.
Oh.
It allowed the Bronfmans to control these vast industrial and real estate empires worth maybe $100 billion at their peak, with relatively little equity tied up at the very top.
But that structure eventually ran into trouble, right?
Oh, absolutely. Became incredibly unwieldy and debt-heavy, leading to a crisis in the early 90s. But that history, that ingrained knowledge of using intricate financial structures for strategic advantage, maybe now more focused on tax efficiency and shielding risk, you could still see echoes of that in how Brookfield is structured today.
Then the firm really found its modern form under the current CEO, Bruce Flatt, often called Canada's Warren Buffett. He took over after that crisis and transformed it. What was his core insight?
Flatt stepped in when the old Braskin conglomerate was really struggling, weighed down by debt and complexity from the pyramid structure. His genius, I think, was seeing that underneath all that financial mess were genuinely world-class, irreplaceable, real assets.
Just he cleaned house.
Systematically.
Yeah.
He stripped away the non-core businesses, simplified things where he could, and focused the entire firm on becoming a best-in-class owner and manager of essential real assets. Think power plants, premium office towers, bridges, ports, things with long lives and stable cash flows.
And crucially, he combined that focus with a core principle, countercyclical investing, buying when everyone else is terrified.
Exactly. Flatt basically operationalized buying panic. He became famous for acquiring major assets for, cents on the dollar when markets were melting down or industries were out of favor.
Like the Olympia and New York assets.
That's a classic example. He souped up some of their prime real estate after their collapse in the early 90s. Or think about his aggressive stance on Manhattan real estate right after 9/11. When fear was at its absolute peak, he was doubling down, buying premium office space because he believed in the long-term value.
Yeah.
He buys value when it's disguised as disaster.
And this philosophy leads directly to what the sources call their unique moat, the capital-backed operator model. Why isn't Brookfield just another asset manager like Blackstone or KKR? What makes them different?
Well, fundamentally, they're a balance sheet first business. They aren't just raising money from others to invest. They invest a significant amount of their own corporate capital right alongside their clients' money.
Real skin in the game.
Massive skin in the game. Management and insiders, through a vehicle called Partners Limited, own something like 20% of the entire company's equity. That creates this incredibly powerful owner mindset. Their interests are completely aligned with their clients and long-term shareholders.
But it's not just the capital, right? It's the operator part that's really key. They aren't just financiers pushing paper.
No, definitely not. They have deep, hands-on operational expertise. They employ around 250,000 people globally who are literally running these assets, fixing turbines on wind farms, managing logistics at ports, overseeing construction projects.
And how does that operational depth give them an edge?
It allows them to identify opportunities and execute operational improvements that pure financial players just can't see or do. They can underwrite deals based on fixing things, not just financial engineering. And they use this expertise to enter new, sometimes complex markets more confidently.
Can you give an example of how that works in practice, entering a new market?
Sure. Take their expansion into India. It's a huge market, lots of potential, but also risks, right? Before they committed billions of client money there, they spent years, I think the sources said 5 years, researching, building local partnerships, and crucially, deploying their own balance sheet capital first.
So they test the waters themselves?
Exactly. They prove the strategy works, de-risk it with their own money, build a track record, and then they launch a large fund for clients. Bruce Flatt summed up their edge perfectly in one quote. It's the combination of capital availability, operating expertise, and our global perspective. It's really the synergy of those three things that makes their model so hard for others to replicate.
Let's make that countercyclical playbook really concrete for a second. The One Liberty Plaza story is a fantastic illustration of this in action. Can you walk us through how they played that specific asset, like multiple times?
Yeah, this one's a real masterclass. Okay,
Yeah.
One Liberty Plaza, it's a huge premium office tower right in downtown Manhattan.
Yep.
So cast your mind back to 2001, right after 9/11. The market is in total chaos, existential panic, really. Downtown Manhattan real estate, considered radioactive by many.
Understandably.
Brookfield swoops in. They buy the building from a developer who'd gone bankrupt for just $432 million. Peanuts, relatively speaking. They stabilize it, manage the leasing risk through the crisis, implement their operational improvements. They bought low during maximum fear.
Okay, so they bought the dip big time. When did they cash in?
Fast forward to 2017. The market is completely different. Commercial real estate is hot. Valuations are high. All the fear from 9/11 has evaporated. What does Brookfield do? They sell a 50% stake in that same building.
At what valuation?
At a valuation of $1.5 billion for the whole building. So they crystallize a massive gain on that half stake, proving out the value they created through both market timing and operational skill.
Brilliant. But wait, the story doesn't actually end there, does it?
No, this is where it gets really interesting and ties back to today's discount. Fast forward again, now to 2023. Interest rates have shot up. The office market is suddenly reeling again post-pandemic. Work-from-home fears are rampant. Panic is setting back in, especially for assets with debt.
So the cycle turns again.
Exactly. And Brookfield, sitting on cash from previous sales and fundraisers, does what? They buy back the exact same 50% stake they sold just 6 years earlier.
Get out. At what price this time?
They bought it back based on a valuation of only $1 billion for the building. significantly cheaper than where they sold it.
So they sold high at the peak, bought back low during the next panic.
Precisely. Sell high, buy low on the same asset. That takes incredible discipline, but also access to permanent capital, which they have, and that deep operational nerve to act decisively when everyone else is paralyzed by fear. That right there is the essence of the Brookfield moat.
Okay, so we've got the history, the DNA, the operator model. Now let's actually dissect the modern structure. Brookfield Corporation, BN, that's the top-level holding company. How does it actually make money from this trillion-dollar empire? What are those 4 toll booths you mentioned contributing to the $5.2 billion in annual DEBR?
Right, the cash flows into BN from 4 main streams. First, you've got the very stable, high-margin management fees. This is basically subscription revenue, right? Typically 1.5% to maybe 2% charged annually on the assets they manage for clients. Very predictable.
Okay, fee income, number 1.
Second, the potentially very lucrative carried interest. This is the performance bonus. Usually it's 20% of the profits generated by a fund after it clears a certain minimum return hurdle for the investors. This is lumpier, but can be huge.
Got it. Fees and carry. What's third?
Third is the income from their principal investments. This is the direct cash flow thing, rent from buildings, tolls from roads, payments for electricity generated from the assets that BN owns directly on its own balance sheet, not inside a client fund.
Okay, the stuff they own outright.
Exactly. And fourth, the newest and maybe fastest growing piece, the wealth solutions segment. This is the insurance business, and it generates income from the investment spread earned on the insurance float.
Right, we'll definitely need to unpack that one. Let's start with segment 1, though, the heart of the fee machine. Brookfield Asset Management, or BAM. How does that relationship work now that BN spun BAM out as a separate company in 2022?
So, BAM is the pure play asset manager. It handles the fundraising, the client relationships, the day-to-day management of the funds, overseeing about $1 trillion in assets under management, or AUM.
Okay.
When BN spun it out, BN kept a large controlling stake, around 75%. So BAM is the engine generating that capital-light, high-margin fee revenue. And those margins are impressive. They expanded to 57% in 2024. Think of BAM as a very stable cash-generating utility for BN.
Okay, so BAM generates the management fees, but you mentioned carried interest, the performance fees. Where do they land? This carried interest phenomenon seems to be a major source of hidden value the market is missing.
Absolutely critical to understanding the discount. When BN spun out BAM, the parent company, BNN, retained the rights to almost all, nearly 82% of the future carried interest generated across all the Brookfield funds, existing and future ones.
Okay, so BN gets the lion's share of the performance bonus, not BAM.
Exactly. And carried interest, remember, represents profits that have been accrued within the funds, but haven't been realized yet. They haven't been turned into cash and distributed.
So it's like profits earned on paper waiting for assets to be sold.
Precisely. Think of it as value sitting there, already created for the fund investors, just waiting for the fund to mature or for specific assets within the fund to be sold. Accounting rules mean this accrued carry can't be booked as cash earnings by BN yet.
So what's the scale of this hidden asset? Why isn't the market giving BN credit for it if it's already been earned?
The magnitude is huge. Right now, there's roughly $30 billion in unrealized carried interest sitting quietly on Brookfield's books, attributable to BN's stake.
30 billion.
Yeah, gross unrealized carry. And management expects about $10 billion of that to be realized, meaning converted into actual cash for BN over just the next 5 years.
Okay, if you translate that future cash flow into a per-share value today, what does that look like?
Well, analysts who dig into this estimate that this pool of unrealized carry alone represents somewhere around $21 per share of intrinsic value for BN.
Wow.
And the market largely ignores it. Why? Because it's unrealized. It's not part of that smooth, predictable DEBR number they focus on. But given Brookfield's track record of successfully exiting investments, the probability of actually realizing this cash is extremely high. So that $21 per share is arguably, the biggest chunk of value hidden in plain sight by the complexity discount.
Okay, that's a huge piece. Let's move to segment 2, the physical empire, the operating businesses. This includes the assets held directly by BN, including their stakes in listed affiliates like BEP for renewable power, BIP for infrastructure, but also the wholly owned assets, particularly in real estate under Brookfield Property Group, or BPG.
Right. These are the long-term, hard-to-replicate crown jewels, the actual physical assets generating steady, often inflation-linked cash flows. But BPG, which holds their big global real estate portfolio valued at about $24 billion, on an equity basis, that's become a major point of controversy recently, mostly due to the negative sentiment around office properties.
Yeah, the market seems to have really hammered the segment. Why is that $24 billion equity book value for BPG being questioned so aggressively? And how does Brookfield push back?
Well, the market sees the headlines, right? Global office distress, rising vacancies in some cities, higher interest rates making refinancing tricky, the whole work-from-home trend.
Sure.
And it assumes a massive write-down must be coming for Brookfield's portfolio, especially those iconic, high-value trophy assets like Canary Wharf in London or Brookfield Place here in New York.
So what's Brookfield's defense?
It's essentially twofold. First, they argue they own best-in-class, well-located properties with long-term leases to high-quality tenants. These prime assets tend to hold up much better in downturns than older secondary buildings. They maintain high occupancy and rent levels.
Okay, quality matters. What's the second, maybe more critical defense? It ties back to that complexity thing, right? Non-recourse debt.
Exactly. This is where the structure acts like a shield. You look at the total consolidated debt across the entire Brookfield Corporation, it's a massive number, around $249 billion. Looks terrifying on the surface.
Yeah, that's a big number.
But, and this is key, management constantly points out that about 94% of this debt is non-recourse to the parent company. It's isolated at the individual asset level.
Can you explain that simply for the listener? What does non-recourse mean here?
Think of it like having a separate mortgage for every single property in the portfolio, a specific pipeline, a single office tower, a wind farm. If, hypothetically, that one specific pipeline runs into trouble and defaults on its loan.
The lender can only seize that pipeline.
Exactly. The lender's claim is limited only to that specific asset securing the loan. They cannot go after the parent company, Brookfield Corporation, or any of its other assets. It creates these structural firewalls, isolating risk. So while the headline debt number of $249 billion seems huge, the actual financial risk exposure to BN, the parent, is far, far smaller because the BPG assets and others are largely ring-fenced by this non-recourse debt structure.
Okay, that's a crucial distinction. Let's look at segment 3 now. Wealth Solutions, BWS. This seems to be the really exciting growth story, maybe following the path of peers like Apollo, but applying it to Brookfield's infrastructure focus.
Yeah, BWS is Brookfield's take on what's become a very powerful financial flywheel model in the industry. You know how traditional insurance companies work, right?
Yeah.
They collect premiums from policyholders, that's the float, and then they typically invest that float pretty conservatively, mostly in low-yield public bonds to make sure they can pay claims.
Right. Safe but low return.
Brookfield's model is much more disruptive. They acquire insurance companies, primarily those focused on annuities and retirement products, capture that stable, long-duration float.
Okay.
And then instead of buying low-yield bonds, their asset management arm, BAM, invests that float into Brookfield's own portfolio of higher-returning private assets infrastructure, private equity, renewable power, private credit, the stuff they know best.
So the float becomes like captive, long-term capital they can deploy into their highest conviction, proprietary investments. How fast has this BWS segment grown?
It's been incredibly explosive. The insurance float they manage grew from just $4 billion about 4 years ago to around $120 billion today.
Wow, $4 billion to $120 billion in 4 years. How?
Mostly through strategic, well-timed acquisitions of insurance companies like American National, Anaco, and more recently, American Equity Investment Life, AEL. And they're not stopping. They have a stated target of reaching $300 billion in managed float by 2029.
$300 billion in float, what kind of earnings could that generate?
If they hit that target and achieve their expected investment spreads, it could potentially generate around $5 billion in annual earnings just for the BWS segment alone.
And that creates this powerful synergy, this flywheel effect you mentioned.
Exactly. It's a beautiful compounding loop. BAM earns predictable management fees for investing the BWS float that's stable revenue for BAM. At the same time, BWS earns the potentially higher spread income, the difference between the returns generated by investing in Brookfield's private assets and the lower returns promised to the policyholders.
So BAM gets capital, BWS gets spread.
Right. It gives Brookfield potentially higher returns on equity than traditional insurers can achieve, while providing BAM with a massive, captive, and predictable source of permanent capital to manage. And importantly, all these asset transfers between the insurance company and the asset manager are highly regulated and subject to third-party valuations to protect policyholders. But this constant regulated recycling of capital between the segments dramatically accelerates the compounding rate for the entire corporation.
Okay, structure, history, the 3 segments we've covered a lot. Now let's look forward. Why is Brookfield maybe uniquely positioned to thrive in the current macro environment, particularly one that might feature, stickier inflation than we've been used to.
Yeah, it's almost like their asset base was designed for resilience in an inflationary world. It goes back to the kinds of things they own.
Mission critical infrastructure.
Exactly. Toll roads, pipelines, utilities operating under long-duration power purchase agreements. These assets typically share a key characteristic: very high upfront capital costs to build them, but relatively low ongoing operating expenses once they're up and running.
Okay, high fixed costs, low variable costs. How does that play out with inflation?
It's pretty straightforward.
Mm.
Most of their revenue contracts for things like tolls or energy sales are structured to be inflation-linked. Either they have explicit inflation escalators built in, or the regulatory frameworks allow them to pass through inflation over time.
So revenues go up with inflation.
Right. But because their operating costs are relatively low and often fixed in the short term, they already built the pipeline that rising revenue translates almost directly into expanding profit margins and growing cash flows. Bruce Flatt has pointed this out many times. Even a small increase in their top-line revenue due to inflation can result in a much higher percentage increase in their bottom-line earnings. It makes them a fantastic natural hedge against inflation.
And this inherent stability, this inflation protection, that must feed into their ability to execute that countercyclical playbook we talked about. Having that perpetual capital base seems key.
Absolutely. Unlike, say, traditional private equity funds that usually have a fixed lifespan, maybe 5 to 7 years, and are eventually forced to sell assets regardless of market conditions to return capital to investors.
Right, the clock is always ticking for them.
Yeah. Brookfield operates many funds structured as permanent capital vehicles, and their own balance sheet is permanent. This means they're never forced sellers. They only choose to sell assets when they think they're getting what Flatt sometimes calls a silly price in a hot market.
And when markets are down,
they can just sit patiently on their capital, which is often bolstered by those inflation-linked cash flows, and wait for the inevitable crises, whether it was the 2008 financial crisis, the 2020 pandemic crash, or maybe the current uncertainty in some real estate sectors. They wait for those moments to become opportunistic buyers. Volatility isn't a threat. It's just a pricing opportunity for them.
Looking ahead now, maybe the biggest tailwind for them is this whole idea of an infrastructure supercycle. Governments everywhere seem strapped for cash, drowning in debt.
Yeah.
They just can't afford the massive investments needed for the energy transition or even just maintaining existing infrastructure. That seems to open a huge door for private capital.
The scale of the need is astronomical, truly global. And you're right, governments are increasingly retreating due to budget constraints. This leaves this massive funding gap. People throw around numbers in the trillions of dollars that only firms with enormous, reliable, long-term capital bases like Brookfield can realistically fill.
And they're ready to step in.
They're perfectly positioned. The sources said they currently have something like $160 billion worth of capital available to deploy right now. That makes them an indispensable partner for governments and corporations needing to build green energy projects, upgrade grids, expand pipelines, roll out fiber networks, build data centers, basically all the critical infrastructure for the modern economy.
And within that infrastructure space, the most explosive demand driver right now seems to be the artificial intelligence revolution. Brookfield looks perfectly positioned there too, given the massive need for power and data center capacity.
You could argue they are the best positioned infrastructure company globally for the AI build-out. Why? 2 reasons mainly. First, as we said, they are already the largest global owner and builder of renewable infrastructure.
And AI needs clean power.
It needs massive amounts of power, yes, but increasingly, the big tech companies demand that it be stable, guaranteed, and clean power to meet their own sustainability goals and ensure reliability. This exact need led directly to that landmark agreement they signed with Microsoft.
Right, that Microsoft deal made headlines. It was huge, wasn't it? What were the specifics again?
It was staggering in scope. They secured an agreement to develop and deliver over 10.5 gigawatts of new renewable energy capacity, specifically for Microsoft, between 2026 and 2030. This will be built across the U.S. and Europe.
10.5 gigawatts. How big is that really?
To put it in perspective, that single deal is nearly 8 times larger than any previous corporate power purchase agreement, or PPA, ever signed anywhere in the world. It just demonstrates the immense trust that major tech companies like Microsoft place in Brookfield's ability to actually execute these incredibly complex, large-scale energy projects reliably and on time.
Okay, so they're powering AI. But they didn't stop there. They seem to be applying their core infrastructure competency, treating physical assets as long-term income generators, to the AI technology itself through something called GPU as a service. How on earth does that work as an infrastructure play?
Yeah, this is a really ingenious move, I think. They're essentially treating computing power specifically, the high-end graphics processing units or GPUs that are essential for training AI models. They're treating that compute capacity as a core infrastructure asset, just like they treat a data center building or a pipeline or a bridge.
So how do they structure that?
Brookfield is building out and providing the actual GPU hardware infrastructure and then leasing it out primarily to the major hyperscale cloud providers and other large AI players under long-term contracts, typically 4 or 5 years, structured as take-or-pay agreements.
Okay, take or pay. What does that mean in this context? Why is that important?
It means the client, the big tech company using the GPUs, contractually promises to pay Brookfield for access to that computing capacity for the duration of the contract, whether they actually use the full capacity or not.
Ah, so it locks in the revenue for Brookfield.
Exactly. It effectively transfers the risk of fluctuating demand and even some of the risk of rapid technological obsolescence of the GPUs away from Brookfield and onto the client who needs that guaranteed capacity. It allows Brookfield to secure predictable, durable, long-term revenue streams from a sector that's otherwise known for being incredibly volatile and fast-changing. They've essentially turned cutting-edge computing power into a stable, almost utility-like infrastructure asset with contracted cash flows. It's the ultimate application of their core infrastructure investment philosophy to the AI boom.
That's fascinating. Okay, so given all these powerful growth drivers, the infrastructure needs, the AI tailwind, the BWS flywheel, what are the specific catalysts that investors are looking for? What could finally force the market to wake up and recognize that potential $100 intrinsic value?
We can probably point to 3 main catalysts that are pretty concrete.
Yeah.
First, and maybe the most impactful in the near term, is index inclusion.
For which part?
Specifically for the spun-out asset manager. Bam! Brookfield Asset Management strategically shifted its primary listing, headquarters, and key operations more formally to the U.S. market. This wasn't just symbolic. It was a very clear move designed to make BAM eligible for inclusion in major U.S. stock indices, most importantly the S&P 500.
And why is S&P 500 inclusion such a big deal?
Because we've seen this movie before with their peers. When other large alternative asset managers like Blackstone and KKR were finally added to the S&P 500, it triggered massive non-discretionary buying from index funds and ETFs that have to own the stocks in the index. This forced buying often leads to a significant and sometimes rapid closing of the valuation gap relative to peers.
Okay, index inclusion is catalyst number 1. What's number 2?
Number 2 is the monetization of carry. Remember that $10 billion in net carried interest Moat expects to realize over the next 5 years.
Yeah, the $21 per share hidden value.
Exactly. As that accrued carry actually gets realized, meaning assets are sold, funds mature, and the cash flows into BN's accounts, it converts that hidden value into cold, hard cash on the balance sheet. When the cash actually shows up, it becomes much harder for the market to ignore, regardless of how complex the structure is. It validates the earnings power.
Makes sense. And the third catalyst?
Third, management is putting its money where its mouth is through very aggressive share buybacks.
They're buying back BN stock.
Yes, significantly. This is probably the strongest signal of conviction you can get from insiders who know the business best. Management is using corporate cash to aggressively repurchase BN shares in the open market, precisely because they see them trading at what they believe is 50 cents on the dollar.
How aggressive have they been?
Their buyback in the first quarter of fiscal 2025, they bought back $850 million worth of stock, was apparently their largest single-quarter buyback ever. That's a profound statement that they view the current market price as deeply inefficient, and that they have strong conviction in that $100 plus intrinsic value figure.
Okay, we've built up a pretty compelling case for why this stock might be undervalued and what could unlock that value. But we absolutely have to challenge this. We need to look at the other side. If the opportunity is this obvious, why is that discount still so stubbornly large? What's the core argument from the bears? What keeps fueling that complexity discount?
Right. The central bear case really comes back to that perceived lack of transparency and the market's skepticism about relying on Brookfield's internal metrics, like DEBR. Critics argue that the complex structure isn't just for optimization. They suggest it might also be used to, well, obscure certain financial realities.
Like what specifically? What accounting practices draw the most criticism?
A key one analysts point to is the way Brookfield often consolidates entities onto its main balance sheet.
Sure.
This means they report 100% of an entity's assets and, crucially, 100% of its debt, even if Brookfield itself only owns a minority economic interest in that entity, say 30% or 40%.
Why is that practice so confusing or concerning for the market?
Because it creates this huge potential disconnect between the enormous size of the assets and debt shown on the consolidated balance sheet and the actual net equity value attributable to BN shareholders. It makes deciphering the true leverage and risk profile from the official IFRS or GAAP statements incredibly difficult, almost, some would say, incomprehensible without deep, specific knowledge.
And that discourages
It
analysts.
certainly seems to discourage many large U.S. institutional investors and analysts from even trying to initiate coverage. If you can't get comfortable with the input data going into your model, you're unlikely to trust the output valuation. It's easier to just stay away.
Okay, transparency and accounting are number one. What's the second major concern? It has to be the debt load, right? We talked about the $249 billion consolidated debt. You explained most is non-recourse, which shields the parent.
Right.
But even with that structural protection, a huge chunk of that debt needs to be refinanced relatively soon. How vulnerable does that make Brookfield if credit markets tighten up?
This is probably the most significant near-term risk factor. While it's true that about 94% of the debt is non-recourse at the asset level, the sources indicate that something like $48.3 billion of that debt is scheduled to mature and needs to be refinanced within the next 12 months.
$48 billion in a year. That's a lot.
It is. Brookfield relies heavily on functioning, accessible credit markets to roll over that debt. If interest rates were to spike dramatically higher from here, or if credit markets were to suddenly freeze up, like they did briefly in 2008 or 2020,
What happens then?
well, they'd face some potentially painful choices at the asset level. For a property needing refinancing, they might have to inject fresh equity capital from the parent company, which is expensive and dilutive to BN shareholders to pay down debt and secure a new loan. Or, in a worst-case scenario, if they can't or won't inject equity, they could risk losing that specific asset to the lenders through foreclosure. So while their permanent capital gives them more flexibility than most, that looming refinancing wall is definitely a constant source of anxiety for analysts watching the company.
And what about the specific issue of office real estate? Even if the debt on those buildings is non-recourse, if the underlying asset values keep falling because of work-from-home trends or rising vacancies, doesn't that fundamentally undermine management's argument that the $24 billion BPG equity book value is accurate? Doesn't that chip away at the intrinsic value calculation?
Oh, absolutely.
Yeah.
It creates a significant valuation headwind, no question.
Yeah.
Even though Brookfield emphasizes they own premium properties in global gateway cities, London, New York, Toronto, Sydney, the shift towards hybrid work seems persistent, and its long-term impact on office demand and values is still uncertain.
So the market worries the book value is just wrong.
Exactly. The market worries that the current book value for the BPG portfolio might be overstated.
Yeah.
If they're eventually forced to take significant write-downs on the value of those office properties, that will directly reduce management's calculation of intrinsic value per share, regardless of whether the debt is non-recourse or not. It hits the equity value.
Okay. And finally, let's touch on governance and succession risk. The firm seems very tightly controlled by insiders, particularly Bruce Flatt, who's been this iconic singular leader for decades. Isn't that concentration of control insiders earning about 20% via Partners Limited a structural risk that warrants some discount?
It's certainly perceived that way by many governance-focused investors, yes. When a company's strategy and success seems so intrinsically linked to one brilliant, perhaps indispensable individual, the plan for who eventually succeeds that leader becomes critically important.
And Flatt's succession plan is?
Well, Bruce Flatt is still relatively young, only around 60, but he has been CEO since 2002. The current succession plan, from the outside looking in, remains highly opaque. There isn't a clearly designated heir apparent. That lack of clarity definitely creates institutional risk.
What's the risk?
The risk is that if the eventual successor lacks Flatt's unique combination of deal-making acumen, his countercyclical nerve, his global perspective, or just his sheer ability to manage this incredibly complex global operational machine, then the entire long-term compounding thesis could be jeopardized. That uncertainty surrounding succession, by itself, probably justifies some level of governance discount in the stock price.
And yet, despite all these valid concerns, complexity, debt, office exposure, governance management, as you said, remains completely unshaken in their bullish outlook.
Absolutely unshaken. They seem to view the current discount purely as a temporary market failure, a misunderstanding, not a reflection of a fundamental flaw in the business or its structure.
Yeah.
Based on their internal projections, particularly their expectation of achieving 25% annual growth in distributable earnings going forward.
Which is a huge growth rate.
It is. Based on that, management has actually publicly suggested that the stock price could potentially reach $176 per share by the year 2029. They seem incredibly confident that, over time, the sheer relentless power of their cash flow compounding will eventually overwhelm the market's current aversion to complexity. Hashtag tag outro.
Okay, let's try to wrap this up and summarize the key takeaways for you, the listener. We've established, I think, pretty clearly that Brookfield Corporation is fundamentally a compounding machine. It's fueled by these three core engines: that deep, unparalleled operational expertise,
Like operator DNA.
a massive permanent balance sheet providing capital and resilience, and now this explosive, almost proprietary growth coming from the insurance side, BWS, and these AI-adjacent infrastructure plays.
And crucially, the takeaway is that this incredible machine appears to be trading at something close to half price, primarily because its structure is so complex and difficult for the general market to easily understand and value. So you should now have the full Brookfield playbook, essentially.
Yeah, you've got the history from Sao Paulo streetcars to global behemoth. You've got the secret sauce, that countercyclical, capital-backed operator model. You understand the key growth drivers, especially that BWS insurance flywheel. And you grasp the full scope of this valuation gap stock trading around $50, while management and bulls see intrinsic value closer to $100, maybe even much higher long term.
And it's clear Brookfield actively uses this complexity. It's not just an accident of history. They leverage the intricate structure not just to control assets, but arguably to optimize taxes, to shield different parts of the business from risk using that non-recourse debt, and maybe to attract a certain type of sophisticated, long-term capital partner who can look past the messy gap accounting and focus on the underlying cash flows.
But that leads us to the final provocative thought we want to leave you with as you mull over this potential opportunity or risk.
Yeah, in a global investment landscape that seems to be increasingly demanding algorithmic simplicity, quarterly predictability, and almost radical transparency, Brookfield is asking investors to do something different. They're asking you to place your faith primarily in operational competence, built up over a century, as the ultimate source of value.
So the question becomes, is that deep-seated, hard-won operational expertise the final, truly non-replicable moat that ultimately justifies enduring Brookfield's structural complexity? Or is the confusion and discount caused by that complexity simply a kind of tax that outside investors have to pay, perhaps for the benefit of the insiders who navigate it so well?
That's the multi-billion-dollar question the market is still wrestling with.
Definitely something to explore further as we all watch to see if and how this massive valuation gap eventually closes. Thank you for joining us for this deep dive into the infrastructure alchemist, Brookfield Corporation.